Good morning, everybody, ladies and gentlemen, and welcome to the Attacq FY26 pre-close update. To those online, welcome to you as well. In person, we have a full house. I'm glad you braved the weather and made the journey through to Waterfall Estate. I'll shortly be handing over to Jackie and the rest of the Attacq management team, who will provide us with operational highlights and performance for the period. But just to those online, as we go through the presentation, and if you have any questions, please include them in the Q&A tab, and I will pose your questions after the presentation. I'd now like to hand over to Jackie for the introduction. Thank you.
Thank you so much. Ooh, yeah, no, not this one. Oh, sorry. Put that one down. Good morning, everyone, and thank you for joining us this morning for our pre-close. And special thanks, Mahir and your team, ABSA, for joining us and partnering with us with the pre-close and then also the site visit for today. So if you miss out on the site visit, please reach out to us at any time if you would like to come and visit Waterfall. As I always say, all roads in Joburg and Gauteng leads to Waterfall. I have specifically asked Brenda to put this picture of the Nzinga Transport Hub as the opening slide to our pre-close, and I just want to draw your attention to this. We're very proud. A few months ago, we opened up this new transport hub in Waterfall City. It's underneath the park, connecting all our transport, online scooter bikes into there as well, connecting to the mall. But this really represents what Attacq really is and what we're trying to achieve. We always say that we build assets not just, to make profit. Yes, I know to my shareholders, we absolutely do that to be profitable. But we do that to be human, to connect communities, to build more than just infrastructure, but really, really live our purpose. And this is a great illustration of bringing a city come to life with great infrastructure investment. Our pre-close today, and I'm happy to say that we're closing off this year, hopefully a week or two left, in a strong position. We have got great operational performances. Our capital structure is sound, and I'm glad to report that our strategic execution for this year has also gone to plan. So now we'll give you just a little bit of an update on I'm giving you some highlights, and then the rest of the team will give you some detail for the morning. Our DIPS here for the year, our guidance remains between 11% and 14%, so that is on track. And in a good year, it's quite a great set of results. In the trading environment we're trading in, it's quite magnificent, the results that we are able to perform. We've also issued a DMTN program, our second one of R1 billion, and Pete will go into the detail of the DMTN program for the year. On the operational side, we're very happy to report that our occupancy is up to 95%. Mike will give some detail today. Collections up 100%. And really, it's a testament of clients choosing our precincts, clients wanting to be, within the Attacq portfolio, but also very much so the hard work of our teams, making sure that our buildings remain full and we also lease the buildings. Trading density up 4.8% with a trading density per square meter of 4,400, just over 4,400. Really seeing still some really good growth coming out the trade, even though we feel that the shopper might be under pressure with the inflation and also the exceptional hike in diesel and fuel costs. At Waterfall City, we keep on building and developing and doing it in a responsible manner, finishing 25,000 square meters of developments. We're on track to build another just under 50,000 square meters of developments, and our Aspire sales just over 70%, of which 61% is bankable, and David will go through the detail today there. But definitely seeing great momentum still in the development space. Then on the human front, we're very happy to now, not anymore interim, but full-time CFO, Pete de Villiers. And again, congrats, Pete, for the appointment. But that really what it brings for us is excellent continuity and then really good financial leadership in our team. We will be replacing Pete's old role in due course. When we look at our ESG component of our business, we've completed 1.8 megawatt of solar for this year. Our water backup, the teams have been very busy with 5.1 megalitres of water capacity. We were really focusing on having capacity between 5 to 10 days within our portfolio. So in summary, I believe that we have really stick to our 4 strategic pillars for the year. We are a precinct-focused landlord. We delivered great operational results with a robust capital structure and an excellent balance sheet for the year. Mike, will you take us through the detail of the operational portfolio?
Thanks, Jackie. So this is just an operational update. Yesterday I sat with one of our asset managers and I said, I just need some information and notes on the last 6 months, although it does feel like it's November already. We've had quite a busy 2026. So this is one of the milestones we celebrated in this picture. Mall of Africa turned 10. Can you believe that? So what a journey it's been for us and for Attacq, being the shareholder of Mall of Africa. It's also been a big contributor to sort of our DI success. And it was fantastic to celebrate that 10-year milestone. If we look at some of the highlights for this portfolio, let's focus on non-GLA income. That's scheduled to still grow with 8% year on year. So once again, that active management outside of the core GLA, making sure that we also tap other revenue streams within the portfolio. We've seen a lot of success with that. Our cost to income ratio is steady at 21.8%. So we've kept that fairly consistent with where it was in the prior year. Once again, just an indicator of the cost control that we able to manage in the portfolio. An interesting statistic, so far we've generated almost 30 million rand in green energy in this portfolio, and that's scheduled to be about 33 million. We're projecting the green energy that we generate on our rooftops by the end of this financial period. Jackie touched on it in the introduction. Kudos to the team, a big stat for us, our occupancy up at 95.1%. Couple of wins for us here, specifically in logistics. You'll see logistics up at 97.2. So we've let what was called the K101 warehouse. That's about 8,500 square meters. And we've let that to a business called Royale. We've also had more entrance into our Collab Hub business. Some successes was the expansion of Premier in Maxwell Office Park. Exclusive Networks also joined us in Maxwell Office Park, and Equinix joining us in Ingress. So positive uptake of space all over the portfolio. Really from a core metric perspective, if you run a property business, you keep your occupancy as high as possible and make sure the money hits the bank. So you'll see our collection rate also very high at 100.3%. We've also noted just the success and the continuation of our water and energy rollout. So those projects still continue, although we're getting to the tail end of them, and it's the last few projects that we're busy with, but certainly strong performance there. On the retail side, and I'm sure I'll face a lot of questions today about the South African consumer, given where oil prices are and all the uncertainty, you'll see our trading density growth at 4.8% so far for this year. The one thing I can mention is that the trends are fairly inconsistent, and it's really hard to draw concrete conclusions around what is actually happening. It does seem to move from month to month, but certainly in Q&A, I'll be happy to discuss some of the trends we have seen. Foot count up at 1.5%, and when I made my notes this morning, I made a note to say, like, if you're still able to say the word growth within foot counts, you're in positive territory, and I think it's certainly positive, although the number itself is maybe not big, but the fact that we're still growing foot count is very positive. We have a picture there of the new Balance and Nike shop that opened at Mall of Africa. That's just a response to the shopping success that we've had for those two brands. Nike have also introduced new brands or new lines into their offering and expanding their store. And once again, we see that as positive evidence of the health of our assets when our clients, the retailers, are happy to invest further in our assets. From a trading density perspective on a per asset or per precinct view, I'm not going to spend time on all of them. I just want to mention we're fairly comfortable with Mall of Africa sitting at about 4,900 rand a square meter. Recently, in this reporting period, we had two competitors open, the most significant of that being Mushroom Farm. And ever since that has opened, we've kept a keen eye on our performance, and we don't think that it has had a significant impact. Also, kind of the bounce back of Fourways under new management there, we're keeping a close eye on that. And so we're very happy with the Mall of Africa performance, notwithstanding those external influences. The next two slides will just take you through our precincts. Once again, there's a lot of information. I'm not going to talk to all of it. But the main point we want to demonstrate here is that we are a precinct-focused business. That is how we like to think about property. But also that these precincts, if run successfully, are actually big economic engines. And what we've made notes of here is the amount of jobs that we create indirectly. So the people that work in our precincts for our clients, You'll see at Waterfall City, excluding Mall of Africa, that sits at about 23,000 people that call this place a place to work every day. At Mall of Africa, that's just off of 4,000. And if we scroll through some of the other precincts, once again, they may be predominantly retail focused, but in Eikersstad Mall, also in Linwood Bridge, big collab hub components there. People that come to work every day. You'll see in Linwood Bridge itself, just under 2,700 people that come to that precinct every day. And that's why we like precincts. The retail isn't just left to its own. As a precinct like Waterfall City grows, more collab hubs means more people that come to work here every day, and that will support the retail in the longer term. Similarly for our other assets. From an operational resilience perspective, I touched on it earlier, just a continuation of our rollout. You'll see on the water backup specifically, that number now sits at 9,300. I think our previous reporting metric was about 8,200 kiloliters of backup. So once again, massive gains. And then the big impact in the GLA, you see that jump significantly, the proportion of GLA, is because this calendar year, we've started focusing on our logistics hubs. So we did all the retail and all the collab hubs first, and now we're getting to all the logistics hubs, and that's why the performance of the percentage of GLA that now has backup water is increasing so significantly.
Thanks, Mike. Moving on to development in Waterfall. So just as a summary, at the moment we've got almost 88,000 squares that we're busy focusing on within Waterfall. The effective GLA of that is 48,000. So from an effective capex point of view, we are just under 1.3 billion. We've completed 2 developments in the period. So that's Ellipse, which is the last phase, or the 4th building, which was about 220 units, and then the second data center with Vantage, which we term 12.1. Under construction, there's quite a bit. So we've got Gateway East. So a few years ago, obviously post-COVID, we triggered our first spec collaboration hub, which was the Ingress Building 3 of about 4,500. That went exceptionally well, and on the back of that, we triggered a further spec, which is Gateway East. Why did we choose that site? Well, it's essentially was built, well, we're building it on a basement that was built when we originally developed the Mall of Africa. So there was about 100 million rand of basement sitting there. So we wanted to convert that into income-producing asset. It's gone exceptionally well. I'll unpack it a little later, but we'll be on track to complete that at the back end of October. We're currently building our first spec warehouse in quite a while. So that's our first development at Waterfall City Junction, which is a JV with Sanlam. That's a 22,000 development. We've also got a client-led warehouse there, which is also within phase 1. And then what we're really excited is we've got the pantry. So as Jackie mentioned earlier, on the back of moving the transport hub to under the mall within the basement there, that allowed us to look at how we want to reactivate that area. And what we were able to do is create our first sort of street frontage. So we've signed up the pantry there, so it'll be part of the mall, and we'll be completing that at the back end of November. A large capex amount for retail, 54 million, and the client is also putting in roughly the same amount. Our big one at the moment is the hotel and conference. This is a JV with the Rabid property developers based in Cape Town. We're a 75% shareholder there. They're the other 25%. We're going out to tender at the back end of next week to 4 contractors. So that's a 180-unit hotel with a conference center attached. Aspire, so that's our second residential development we're doing within the city. That is also a JV with Tricult, so the same partner that we did Ellipse with. I'll unpack it a little bit later. We've had a few delays there from a zoning and subdivision point of view, which we've managed to get through. So we are hoping to be on site within the next month, and we have appointed WBHO as the main contractor there. And then we've got the City Lodge expansion. So that's the City Lodge next to Deloitte's. That's a further expansion of 55 rooms. So this is just Gateway East. So as I mentioned earlier, we're on track to finish this within October. It's been really, the take-up from market has been exceptional. 62% of the space is spoken for. If you compare it to the Ingress Building 3, which was as I mentioned, the first spec we've done since COVID, of 4.5. This is 12,000 squares. If you strip out the retail component, you're looking at about 10,000. So we definitely feel that Waterfall has got a positive trend towards the office space. I think the design shows that it works, and our leasing team has done an exceptional job over the last 6 months. So this is a summary of the infrastructure that we're currently putting into Waterfall. Since the launch of Waterfall City, this is probably the biggest amount of capex that has been put back into water from an infrastructure point of view. Lawrence and his team are doing a really great job here. There's 6 major items that the guys are running on at the moment. So obviously there's the K60, which is a partnership with government. They're a bit more of a watching brief with governments rolling that out. That project has started. So that'll connect within Allendale over the N1 highway into Sunninghill near Eskom. A project we have mentioned before was the conditional sale of Riverview. So that's the purple portion you'll see on the map to Balwyn. That's allowing us to put in the infrastructure to unlock the 4th entrance into Waterfall City. As I mentioned in previous results presentations, there's quite a focus on development around the mall at the moment. So this entrance obviously helps activate that more and helps with the traffic. A lot of work is going into Waterfall City Junction, so you'll see that on the tour as we go. So there's infrastructure going into 4 phases. Phase 1 is proclaimed, but there's a large amount going into phases 2 to 4, which will be finishing early next year. And then we've also got some water infrastructure where we're involved in our 10 milliliter Carlswood Reservoir, which will allow us to open a few more pockets of collaboration hub within the next year. So this is just a 3D image of Waterfall City Junction. The most western pocket is phase 1. It's about 150,000 squares of the total 600,000 squares of bulk. It's 6 phases in total, so it's covering 1.6 million squares, of which 1.2 is usable. So essentially where all the infrastructure that is currently going in is north of the K60, which covers the first 4 phases. And then the 2 developments that we've got planned is obviously in phase 1. And we have a further 150,000 squares of inquiries currently on phase 1. Okay, with that, I'll hand over to Pete.
Thanks, Dave. Okay, I think Jackie's already said guidance is intact, so there's not too much else for me to say at the moment. But the 2 slides I've got talk mainly to debt. The debt story since December is largely our recent DMTN issuance of just over R1 billion in mid-April. So you'll see our gross interest-bearing debt went up by a little bit less than R1 billion. That's because we've got some RCFs where we could put funds into. That's obviously flowed through to our weighted average lease term. So it would have come down from June by almost 12 months. And then obviously we've got some new longer dated debt in the 3- and 5-year buckets on those bonds that we issued. Our hedging still above 70%, so sitting at 74%. And our weighted average cost of debt coming down. That's largely as a result of the attractive rates that we achieved on our bond issuance. Overall, across those two tenors, they both came down by approximately 30 basis points. So the average on those 2 tenors is roughly about 105 basis points above 3-month JIBAR. Very attractive. The gearing and the RCR, we only measure those at full and interim periods. So those are the December prints that you're seeing there. That's not updated. You can see our available liquidity is up substantially from 1.5 billion that we reported in December to 2.3 billion. And then the bank covenants that you see there are also only measured at interim and final. So those are still the December numbers that you're seeing there. If we look at our debt and hedge maturity roll-off profiles, this is 12 months forward from April. So obviously in the next 12 months, the small debt you see there, that's just interest coupons, so there's no capital. Then some more activity in the 13 to 24 month bucket from a 12-month perspective, or from a debt roll-off perspective. There's some A-week debt in there, and then also our first 3-year bond that we issued is coming up for maturity at that stage. From a hedge perspective, there are some hedges rolling off. So that R1 billion of hedges rolling off. So it's not, some of that's just cash flows on longer dated hedges, but of the hedges that roll off in the next 12 months, they're probably printing at around about an average rate of 7.2. So there's not a lot of room to get any meaningful upside. It's actually slight downside, but that might change by this afternoon depending on what happens in the world. So yeah, it's fairly neutral in that perspective. And then from a funding mix perspective, obviously with the increased DMTN exposure, that's gone up to 23% of our book and was roughly at about 10% in December. There we go.
Thank you, team, for the update. Before we hand over to the floor for questions, maybe I'll pose a few. There's nothing that has come through online yet. So just two participants online. If you'd like to ask a question, please post it in the Q&A tab. Maybe Pete, given that you're the newly appointed CFO, I'll start with you. Just in terms of guidance, so the range is still quite wide. I mean, any reason why you didn't provide a tighter range?
There's still a few days to go till the end of the month, so you never know. Obviously, I think we'd be probably, if you see a wide range, you're probably in the middle of the range generally. So, but remember also, every 7 million rand is literally 1%. So it seems like quite a wide range, but if you put in numbers, it's not a big. 7 million bucks can pop out of the woodwork either way. So we're happy with the range where it is, and but I think we are trending more towards the mid to up of it at the moment.
And then just on the data and hedge maturities, I think you've pointed out that the upcoming hedge in the next 12 months, the rate there is 7.2, so slightly, I mean,
slightly negative.
Slightly negative going forward. Just on your DMTN issue, I mean, given the success of the most recent one and the expiry coming, well, that would sort of come up. I mean, the intention there, I'm assuming, could be to continue to tap the DMTN market?
Probably. Obviously, we need to deploy what we've got. Dave's obviously stepped through the development pipeline, so we obviously need to make sure if we are raising debt that we put it to work as quickly as possible. It wasn't a very attractive rates that we achieved. I mean, the market is obviously very hot, and we were glad to be able to access it at that time. But that is probably the logical place, unless of course our relationship bankers can pull a rabbit out of a hat. Yeah. So
and then
no stress.
Just on the hedge exposure, so that's trended down. I think given the uncertainty in terms of where interest rates are going, I think it reflects in your hedge sort of percentage.
Correct.
Maybe just clarify, I mean, when you would start to increase that hedge percentage, or where you're comfortable?
We've got a minimum policy of 70%. That's to stop pure speculating too much. So obviously the best time to have fixed would have been before the drama played out, but we were actually all expecting, obviously, a great year from an interest rate perspective, and it hasn't turned out like that as planned. So we'll chip away and make sure we maintain our 70% as needed, and Pierre's also obviously looking at other instruments, potentially caps offer better value. It's always a bit of a gamble, but the 70% will be maintained, and if we do spot value, we might add a little bit more.
Thank you. Just on the operational side of things, if we think about, if we sort of track back to the updates that we've seen from a retailer perspective, I would say generally trending weaker. I mean, your trading density number sort of, I think, tracking slightly above where you were in the first 6 months of the year. Occupancies remain quite healthy, but I know you indicated that there's not sort of direct trends or obvious trends that you are seeing. But just from a trade perspective, I mean, are you seeing certain categories perform relatively better or worse compared to the first 6 months' performance?
Yeah, so from a continuing trend perspective, the one thing I can state is that health and beauty seems to still be doing really well, and we see that across the board. Maybe not the significant double-digit numbers we saw a year ago, but certainly from a growth perspective, it's still a growth category. From an apparel side, it's been a mixed bag over the last, I'd say, 8 to 10 months. Some months there's some good performances, other months there's not. We engage our retailers often. Maybe I'll use a non-listed example. It'll just be fair to use a non-listed business, but we engaged Cotton On a while ago, and they said, you know what, it's not external factors. They got some of their stock programming wrong. And 2 months later, they were growing at 10s and 20s again. So I think some of it relates to the retailer specific and their business. Some of it's maybe more the macro environment. But once again, I'm always caveat any answer that comes out of Attacq, because really, once again, we're a precinct-based business, and you might say that to a degree, there's a little bit of a shield or defensiveness around that. When you've got Linwood Bridge, where you've got all these office workers in that retail precinct, there's a form of sustainability there, and I think maybe it shields us a little bit.
And then, just from a renewal perspective, you haven't provided much data, or we haven't provided data in the update, so I'm not sure whether it is available. But if you can provide some color in terms of where the renewal growth has gone, and maybe specifically touch on Mall of Africa, given the 10-year renewal cycle.
Yeah. So far results, we'll obviously publish the full table with all the reversions and all the renewals. Maybe let me start with Mall of Africa. So this is a big project for our team. We set them some targets, and I think they performed exceptionally well. So we had 107 leases to renew by April of this year. Of those 107, we only non-renewed 9 of them. And so we found replacements for most of them. And there's about 9 of them that I would classify as, let's say, month to month. So we're still sorting out the final details. But everyone's fairly comfortable to stay. So of the balance, what would that be? About 92. Only 8 of those we renewed below the target. So it's not the expiry rate. It's whatever rate we gave them as a target. And probably the 2 most significant of those to mention would be Game. So we have an arrangement or concluded an agreement with Game to potentially convert that to a Walmart. Timing is still a bit uncertain, but for that there was a sort of a commercial deal that we did. So if executed, the Game renewal will be below if it opens as a Walmart, and the other one was just Mr. Price Home. I think it was about 5% below the target, and that was purely the size of that box. Maybe we were a bit aggressive on where we felt we could renew that. So overall, I think a very positive result for the Mall of Africa 10-year renewal cycle. If I focus on collab hubs, I think we've had a lot of success in Waterfall City specifically. I think our role of profile outside of the city, maybe focusing on Stellenbosch and Limwood Bridge, not as high in this reporting period. But in Waterfall City, certainly, there was a very high renewal percentage. I think it's close to 92, if I recall, for collab hubs. So certainly it looks like we're able to retain our office clients in our portfolio.
Just one final question from me. I see there is a question that has come through online, and before we open it up to the floor. Just on the cost efficiency side of things, so your recoverability of municipal costs still quite high, your net cost to income ratio relatively static. I mean, are there any more efficiencies you can draw from that? I mean, you showed the slide earlier in terms of the extent of, for example, water backup.
I think maybe as management, we should never say that we're satisfied, that the job is done. So I think there's always something you can do. We're working, and I mean, it's unfortunate that I keep coming back to Waterfall City, but really, yeah, we're in a position where we've reached a certain scale where we're starting to now investigate the way we run not only our landscaping and security, which has kind of been on a precinct basis for the last 12 years, but aircon maintenance. Some of the other stuff that happens in your business, can we do that at scale in a place like Waterfall City to gain more efficiencies in the way that we operate and the way we engage our suppliers? So we're looking into things like that. I think from the operating cost, what we've also done well recently in the past, maybe we were hurt a little bit by the vacancy. So of course, if a property is vacant, the security costs, the landscaping, the rates and taxes, that's for your book as a landlord. And certainly filling those vacancies, getting our occupancy up is helping a lot with the management of costs.
Yeah, there's about 28,000 square meters of vacancies to fill. And then I think maybe to add, where there is some further gas in the tank is we've signed, 2022, we signed a power purchase agreement, and that we are hoping to come online in the next year, within the next few months. We've also looked to upsize that there will be further upside in years to come. And then we're also looking at some virtual wheeling agreements at certain of our precincts as well. So we always look to see where there is further growth in the portfolio.
I'll just take the question that came in online. So just to confirm that Vantage JHB 11.2, so if I'm getting that right, is fully completed and operational.
Yeah, so Vantage's strange numerical ways where they do their buildings. So 11.1 and 11.2 is actually the same building. That's phase 1. So 11.1 was the first half of it, and 11.2 was the second half, and then 12.1 is essentially the second building. That campus will be 5 buildings once complete. It's operational. It's operating. Yeah.
And then can you confirm at all the megawatt load of the stated additional 3 data centers planned for the campus?
Yeah, so initially the whole campus was planned for 50 MVA. So phase 1 was 15, and then the second one was about 12, sorry. But that is scalable to 150. So when we do finish the full 5, we can scale it up to 150, which is good. That's the way the guys are designing them at the moment.
And then there's one further question on this. So will Attacq be partnering on these, and will they be on the dark shell basis, if so?
Yeah, so the remaining 3 will be done on exactly the same structure that we've done the first 2. Yeah, so we will be partnering. 50/50, obviously subject to our IC approving the transactions. Yeah.
Maybe I'll just open up the floor if we have any final questions. Sure.
Thanks very much. Just a quick one around the data centers. I mean, obviously, the precinct approach, your office provides workers that feed the retail. Retail creates the appeal that pulls in the offices and the workers, et cetera, et cetera. Data centers are low labor, large GLA. How does that fit into the precinct model other than just as straight rental income?
Maybe I should just start with, so 100% correct. It's Fort Knox, you can't get into it. It's a fortress. We would like to show people on the site visit, but we can't get in there. 100%. So for us, the precinct approach is 100% sound. We've got 100,000 square meters of bulk further to develop out. So as a responsible landlord, we also look at how do we unlock the bulk and have a diversified portfolio within the precinct. And because we're on the Eskom grid, we're able to attract large amounts of power to the precinct. So it's a mixed bag that we always try and fill in a precinct. It's one thing is, adding offices, adding the spice, adding the beautiful urban design component. And this is on the one side of the highway. On the other side of the highway, it's more the logistics precincts that we are focusing on. And what great benefit is bringing in something like a data center. We've upped the security. Everything is just absolutely top notch because of the data center that we have brought in line. So it's always a diversification, mixed bag, ensuring that we balance not just bringing people, but also the financial component of our business as well.
Morning, Trinity Ngove from Anchor Stockbrokers. Maybe just to build on that data center question, are you able to maybe give us some color on how much water these data centers are consuming? My understanding is that these things consume quite a lot. So that would be the first question. Second question, Garden Route Mall, the recent floods, can you just comment on that and how that affected trading and all of that? Last question, logistics. What rent have you achieved on the newly let space? Thank you.
Okay.
So on the water, I can't give you that exact figure, but the way the guys are designing at the moment is a closed loop. So you're actually circulating the same water all the time. So what the guys are obviously debating is, are we doing air cooling or are we doing liquid cooling? The first one that we did was air cooling, but that was pretty much a cloud-based data center. Where they're obviously moving to now is hybrids, and then you've obviously got your standalone AI. But because you're running more data, those servers get hotter. So what happens is they're also putting the racks close together, but then you need to run liquid cooling. But basically what they're doing on a sustainability point of view, it's a closed circuit rotating the same water to keep the servers cool. Yeah.
Garden Route.
Yeah, so Garden Route Mall, it's a nice question. It links a lot to Pete's wide guidance. So we suffered some damage. The damage is just under about 4 million rand that we suffered there. Of course, we fixed it, and then there's a claim against the insurer for that. But we're fairly impressed with our team. So on the day, the team made a decision to evacuate the mall at 11:30. So all our shoppers and also the staff from the retailers were evacuated safely within 15 minutes. The mall was then closed. I think it was a Monday, if I do recall, that those big storms happened. And the damage is mostly cosmetic. We had a couple of roof sheets and stuff like that, a couple of water leaks, but all of that's been addressed and fixed. I can also do on the rentals. So from a new deal perspective, we had about 170 to 180 net. So those are the type of so net deals. If you gross that up, that's closer to 225, 230 gross from a Colab perspective.
Logistics.
Logistics is about 90 net.
Yeah,
David, that's about
the number.
Yeah.
Any further questions? I think maybe just in the interest of time, I know we have a busy day ahead of us. I'd like to take this opportunity to say thank you to the Attacq management team for allowing us to facilitate this and for the remainder of the day of the site visits that we'll be doing. Maybe, Jackie, I'll hand over to you for any closing remarks, and then we'll close the session.
Yeah. Oh, I've got a mic
Sorry.
on. Thank you once again for Absa for co-hosting it. Always reflecting back on this year, we started off the calendar year with saying there's a lot of tailwinds. and then there's a lot of uncertainty. And I think what we keep on learning is that in Attacq, we control what we can control, and the uncontrollables will sort itself out. So we've got a strong balance sheet. We'll continue with our strategy of a precinct-focused precinct landlord and developer over the next year to come. We're working on some exciting new transactions that the team is working very hard. But again, once again, a heartfelt thank you to our shareholders, our analysts, all of our stakeholders, media, bankers, for attending today, for being online, and always being, just a phone call away for advice or guidance. I hope everyone enjoys the site visit today, and for everyone online, thank you so much for your time and joining us today. Yeah, thank you.
Thank you.